Today we'll be talking about the foreign exchange risk. So what is foreign exchange risk? Foreign exchange risk, also known as the exchange rate risk, is the risk of financial impact due to exchange rate fluctuation. In simpler terms, foreign exchange risk is the risk that a business financial performance or financial position will be impacted by changes in the exchange rates between currencies. And also, foreign exchange risk is a major risk to consider for exporters or importers and businesses that trade in international markets. So we have the three types of foreign exchange risk. The first one is the transaction risk, economic risk, and lastly, the translation risk. Before we proceed, the three types of foreign exchange risk, let's now talk about the foreign exchange exposure, which risks occur when a company engages in financial transaction or maintains financial statement in a currency other than where it was headquartered. So, here are the examples. So, a company based in Australia that does business in Canada. So, for example, it is received financial transaction in Canadian dollars and reports its financial statements in Australian dollars. It's exposed to foreign risk. So the Canadian dollars receipt must be converted to Australian dollars before writing the company's financial statement. So changes in the exchange rate between the Canadian and Australian would be the risk, hence the term of foreign exchange risk. So here are the types of foreign exchange risk. The first one is the transaction risk, which means it is a transaction risk is faced by a company when making financial transactions between jurisdictions. And the risk is the change in the exchange rate before the transaction settlement. So the transaction risk can be mitigated using forward contracts and options. The next is economic risk. It is also known as the forecast risk, is the risk that a company's market value is impacted by unavoidable exposure to exchange rate fluctuation. So, economic risk is a type of risk is usually created by macroeconomic conditions such as geopolitical stability and or government regulation. So, for example, an Australian furniture company that sells locally will face economic risk from furniture importers, especially if the Australian currency is unexpectedly threatened. Then the last risk is translation risk. It is also known as the translation exposure. It refers to the risk faced by a company headquartered domestically but conducting business in a foreign jurisdiction and of which the company's financial performance is denoted in its domestic currency. So, and also, when we say translation risk, it is a higher when a company holds a greater portion of its assets, liabilities, or equities in a foreign currency. Um, for example, parent company that reports in Australian dollars but an overseas subsidiary based in Canada face translation is as the subsidiaries of financial performance is in Australian dollars, it is translated to Canadian dollars for a reporting purposes. We have the courses of FX. The first one is economic and political events. It is the interest rate changes or political events such as the election or war can cause currency values to fluctuate. Then the second one is the market speculation. It is a currency speculators can buy and sell large amount of a currency causing its value to fluctuate. Then the third one is the interest rate differential. If the interest rate in one country is higher than another, so the investors may move their money to the country with the higher interest rate, causing the currency to appreciate. Then the fourth one is the balance of payment. When you say balance of payment, it is a country with large trade deficit or high level of a debt may see its currency depreciate as investor lo- lost lost confidence in its economic stability. Then the fifth one is the currency intervention. It is a central banks may intervene in the currency market by buying or selling a large amount of a currency to try to influence its value. Then the sixth is the natural disaster. It is such as hurricanes, earthquakes, and pandemics can disrupt trade and cause currency values to fluctuate. Then the lastly is the technology advancement. It is it says that advancement in technology and communication have led to increased trading and investment opportunities, leading to more volatility in currency exchange rates. Then we have the foreign exchange risk management techniques. So the mitigation of foreign exchange risk is a key risk management objective in the investment context. So the first one is the going short the currency or the swap. When you see going short the currency, it is for example, if we invest in India as a U.S. investor in a publicly listed company, we of course want to take exposure to the upside of the company we invested in, but we don't want the currency risk. So we could sell INR equivalent to the amount of investment we have done in that stock. Then the last is the swaps. These are niche products, but swaps in bonds of foreign countries can give us the option for cash flow in either domestic or the foreign currency. That's all it. That's all. Thank you.